The age of agentic AI was supposed to kill software companies, especially a company like Shopify, which helps merchants, big and small, set up their storefronts in real life and on the internet. But the opposite has actually happened. The age of agentic AI is driving more and more traffic to merchants who are using Shopify to set up their storefront. And that was on full display as the company reported earnings before the market opened this morning. Shares were up by as much as over 20%. They've settled down to around 15 or 16% right now. So what does this mean for shareholders? Let's take the next couple of minutes trying to figure this out. My name is Brian Stoffel. At the time of this recording, I do own shares of Shopify. This was their second quarter of the year. Market cap is around $295 billion. On the top line, revenue grew 34%. That beat estimates and came in way ahead of guidance of high 20% growth that management had. Earnings per share of 42 cents was up 20% from last year, beat analyst estimates. Management guided for free cash flow margins in the mid-teens. I'd say free cash flow margin coming in at 18%. That's high teens. That's a beat as well. Now, when we look at margins, speaking of margins, it's kind of a mixed bag. Gross margin went down, but here's the funny thing. You actually want gross margin go down for Shopify. That might sound confusing, and I'll explain that when we go to some of the things on fiscal AI, but that's not a concern. The fact that operating margins went up is the most important thing. Net margins matter less to me because they can be affected by a whole bunch of things that don't reflect the underlying business. Free cash flow expanded meaningfully. Net income was up. The balance sheet, pristine shape. About net position of $5 billion, no debt whatsoever. Let's go down the income statement to talk about this. All right. So revenue is up 34%, but the cost of that revenue is up 36%. But note, and this is where I'll explain the gross margin part, that there's two different lines of business. Okay. Subscription solutions. That, say I'm setting up a shop. I have to pay a flat rate every month to Shopify to use their platform to set up shop, to have somewhere where people can go to, say, buy the coffee that I have. Obviously, I would ship it to them. I can't ship them hot coffee. And so I pay a flat rate. Now, there are different tiers, but the revenue that comes from that is much less, but much higher margin because it doesn't cost Shopify as much to just ship that software. The other one, which as you can see, Merchant Solutions is much more of the revenue, that is success-based. If I sell 2 bags of coffee and I use, say, Shopify to help with Shopify payments, well then, Shopify will collect a little bit of money, but because I'm not successful, then they're not going to get a whole much more on top of my flat rate that I pay every month. If, however, I'm selling hundreds of thousands of bags of coffee every month, and of those, 80,000 are using Shopify payments or other merchant solutions, well, then all of a sudden, Shopify is collecting a lot more revenue. It's lower margin, but it's a lot more revenue. So what we really need to do is we can look and see that gross profit grew 31% versus 34% revenue, and we code that red. But what we really need to do is look at the underlying margins of these two. Now, for subscription solutions, the gross margin fell, and meaningfully so, from 81.6 to 79.7%. However, it is really important to know why, because most time management teams will talk about why gross margins fall, and I feel like I should have a buzzer that I buzz to tell them, like that's not fair. You had lower prices because the competition's undercutting you. In this case, I actually do believe what management has to say, which is that they have AI tools that are available now and part of a subscription solution, and they have to pay for compute. That will bring down margins, and that's okay as long as it drives more merchant solutions and more gross merchandise volume. So on this, I am willing to cut Shopify some slack. And it's worth noting that as their GMV grew, the gross merchandise volume, the value of all the things that people sold on Shopify's marketplace, their margins for merchant solutions got better as well. Not by a ton, but they're getting better. And this is where it really looks great. So revenue grew 34%, but operating expenses only grew 21%. And when you combine those factors, even with gross margin shrinking, operating margins expanded 68%. That is great to see. Now, to see what else went on during the quarter, we're going to go on over here to fiscal.ai. Now, this shows the breakdown of what I was talking about before. This is the high margin subscription solutions. This is the lower margin merchant solutions. Those are the only two business lines they have. So if we look at subscription solutions, it's worth noting that the revenue that they collect has been accelerating for the past 4 quarters, and that continued with subscription solutions up 22% during the quarter. If we look at merchant solutions, what we see is that they were up, if we look here, 37%, and they have been growing at over 35% for 5 consecutive quarters. That's great to see as well. But there's more that we can check on, and there's more that's important to check on here as well. The next thing I want to pull up is probably the most important one, which is gross merchandise volume. In other words, of all the stuff that merchants sold, all the coffee that Brian sold on his website, multiplied across all the merchants that set up on Shopify, how much stuff traded hands? And the answer is about $116 billion worth of stuff. But this is the really important part. The value of all that stuff, if we look over a long enough time frame, and you know what, let's pull this back even more. The value of all that stuff just continues to grow, and the growth rate continues to go up. Now, it did take a step down with gross merchandise volume growing 32%, whereas it grew 34% during the first quarter. But look at the trend. The trend here is not just growth, but accelerating growth. That is the most important thing that you can see if you're a Shopify investor. This right here. Not only are people buying more things on the merchants who use Shopify, but the growth rate of buying more things is increasing over time. That is incredibly important. Let's also look at total gross payment volume. So this is all the people that, the merchants that are using Shopify Pay. And so you see there was about $116 billion worth of stuff sold, and about 78 billion of that was sold using Shopify Pay, Shop Pay. There's still room for this to grow. And this is what drives a lot of that merchant solutions growth. And this is why that you'll see that growth, the trend there follows very closely with the growth trend that you saw for merchant solutions. That's good news. Another thing that I think doesn't get enough credit but is really important is this monthly recurring revenue. Now, this is a pretty small number when you consider that the company is reporting between $3 and $4 billion of revenue per quarter, and they publish this monthly recurring revenue of just 220 million. This is like quarters. But the reason it's important is because monthly recurring revenue will only increase if you get more merchants signing up, or if your existing merchants upgrade to a higher tier. It's actually really important because these are like the seeds that are being planted in the ground to create giant sequoias in the future. And it's important because, really, since agentic AI became really important, and since a price increase has been digested, you can see back here, there was a price increase to the monthly plan. So for a little while, this growth was really high, and then it kind of reset. And now that people are seeing this agentic AI is actually driving more traffic to independent merchants, who, by the way, mostly set up on Shopify, than they are big aggregators like Amazon or Walmart, that it's attracting more merchants to set up their own shop. And so you see that this growth rate accelerating for monthly recurring revenue is a very positive development for the future of Shopify. The last thing that I want to point out is the attach rate. Now, what this generally means is if you take all the gross merchandise volume, all the money that trades hands through Shopify selling things, how much does Shopify get to keep? And the answer is about 3.1%. Now, that is a step down from the first quarter, but the most important thing is that it's a step up from the year ago quarter. And again, if we pull this back further, what we can see is a very clear trend here. Now, I don't know how much higher it can get, but any any stepwise upwards is very, very positive for the business moving forward. So let's look at what management had to say moving forward. So what management had to say was they expect low 30% growth. On the left here is what management said. Low 30% revenue growth in the third quarter. And analysts were just expecting 26% growth. Guys, this is a big deal. When Wall Street expects 26% growth and you come in and say it'll be the low 30s and you blow that out of the water, I wouldn't be surprised to see it come in 34, 35%. That's a meaningful raise over what was expected. And management doesn't guide to earnings per share, but they did say that their free cash flow margins would be in the high teens or low 20s, which is a meaningful improvement from about 18% in the same quarter last year. So what should shareholders watch moving forward? I'm a shareholder myself. Number one, by far, is that gross merchandise volume growth. We want to know that the merchants are experiencing success using Shopify's platform. Second, the monthly recurring revenue growth, the totally overlooked metric that talks about the quality of the seeds being planted now for the future. Number three is that attach rate. Any step up means that the company is becoming more profitable and the moat is widening. And number four are free cash flow margins. No doubt, to me, no doubt that the moat is widening and the thesis is on track. The big question then becomes, what about valuation? Before we get to that, if you enjoy this type of breakdown, you would be a perfect candidate to join Stock Investing Mentor, my own investing platform. It has 3 pillars. Pillar number 1, you get real-time access to my real-life portfolio. Pillar number 2, you get access to the antifragile stock universe. Every stock that I own and follow, ranked by antifragile score and valuation. And number 3, 1 hour of live weekly training and 24/7 access to a private online investing community. And it's worth pointing out, with that antifragile universe, you will also get this at the top of every month, the top 5 stocks that I would buy if I was starting my own portfolio today. And I call that out because back on July 1st, I called out Shopify as one of those 5 stocks, and it has done very well since then. And not only that, but if you join this, you also get access to Stock Simplifier Pro absolutely free. That's a $400 to value, absolutely free. So if that interests you, click the top link in the show notes below and you get 10% off a Stock Investing Mentor membership. Now, what is Stock Simplifier Pro? Well, let's head on over to show you what it looks like. You can investigate a company's business, its moat, its growth potential, the risks that it might face. But I really want to zoom in here on valuation. Now, we could look at Shopify's valuation, say on a trailing free cash flow basis and say, 80 times trailing free cash flow, almost 100 times trailing earnings, way too expensive. Get out, sell. I don't think it's that simple. And you knew I was going to go in this direction. If you do an optimized reverse discounted cash flow analysis, if we give the company, I'm even willing to give it a 3.5% terminal growth rate. The reason for that is because I believe that this company has a wide moat. They can raise prices and their growth runway is well over the next 10 years. So I'm willing to give them a 3.5% terminal growth rate, a 10% discount rate, which means that I want this to be a market matching return, or at least see what are the assumptions necessary for a market matching return. And then I have to optimize this free cash flow margin. Now, it's been all over the place in the past, but since they've jettisoned their logistics business and they say that they're going to be in the low 20s, I believe this company could have a free cash flow margin of anywhere from 23 to 25%. Let's be bullish here and put it at 25%. So what does this mean? 20% being right here. That means that Shopify needs to grow their revenue by about 20% per year over the next 10 years to justify today's stock price, getting that free cash flow margin and that terminal growth rate along the way. Is that reasonable? Well, we can just go over here and look at where revenue growth has been, and it doesn't look too bad. So they need 20%. Notice that every year since 2022, they've been able to accelerate their growth rate from 22 to 26 to 30 to now 33. Now, what is expected moving forward? Well, it's expected to hit about 28% this year, followed by 24%, and then accelerate to 26%. I'm not buying this, though. And here's the reason why I'm not buying it. Those are guesses, and we should go see how accurate have those guesses been in the past. And that's what this screen right here tells us. And it tells us that analysts have consistently underestimated their guesses for how much revenue Shopify would get, and they've had to move it up. That's why this line, which represents last year's revenue, keeps moving up and up and up as you go along. Or this year's revenue, which started at 13 billion, but now they're guessing about 15 billion. Or when they started guessing about what kind of revenue the company would have next year, they said, about 17.3, but now it's up to 18.3, and my guess is in the next week or two, it's going to go well above 18.5. So I actually think that when we look at these numbers, we need to move them forward too. And call me crazy, but I believe that over the next 3 years, Shopify could average between 28 and 30% revenue growth. Maybe you disagree with me, and that's fine, because when you become a member, you can go ahead and you can put in your own numbers here. But if I go split growth and I say I think the company can get 30% growth per year over the next 10 years, well then revenue just needs to grow 16% from year 4 through year 10. I believe the runway is really, really long for this company to continue gaining market share and dominating. So I don't necessarily think it's a steal at today's prices, but this seems much more of a fair value than what the multiples would have you believe. So those are my thoughts on Shopify. Let me know what you thought of the company's results and the valuation in the comments section below. And until next time, Brian